Hi, I'm Chris Hearn, the founder and CEO of Fountainhead Commercial Capital. Today I'm going to talk about something I get asked all the time, which is 7As versus 504s. Which one's better? Well, the short answer is it depends on the use of proceeds. 7A is a tremendous loan program, but for the right use of proceeds, just like the 504 is also a tremendous loan program, but for the right use of proceeds. So let's start by talking about what each loan is best used for. The 504 loan is best used for owner-occupied commercial real estate financing or heavy equipment financing, and that's it. There aren't any other use of proceeds you can use a 504 loan for. Unlike the 7A, when you can use for business acquisitions, working capital, partner buyout, real estate, equipment, and so on. So then that begs the question, well, all right, if there's different use of proceeds, what's the real differences in the loan programs? Well, there's primarily two. The first is interest rates. Let's address that first. The 7A program is oftentimes a floating rate loan program based off of prime. Now, that's pretty much the only option that most banks and credit unions offer to their borrowers under the SBA 7A loan. Well, that is far inferior when you're trying to finance commercial real estate. You're getting a floating rate on a fixed asset. That doesn't make a lot of sense. In fact, it's one of the reasons why I myself have an SBA 504 loan. That's how much I believe in the program. When you have fixed assets like commercial real estate, I think it makes most sense to get fixed interest rates. And that's what we provide here at Fountainhead for the first lien piece of 504 loans. So that's the first issue. The second issue is about collateralization. The SBA, unfortunately, has had a lot of horror stories over the years about requiring all sorts of collateral to be pledged for their loan programs. Unfortunately, most of that applies to the SBA 7A loan program and not the 504. The 504 generally collateralizes only the real estate or equipment that we're financing, nothing else. The SBA 7A loan, unfortunately, by statute, is a fully collateralized loan program. That means when you've heard stories about borrowers having to pledge seconds on their personal residences and get life insurance, having UCC filings on inventory and receivables that might impede their ability to get lines of credit later on, all that happens with an SBA 7A loan. It doesn't happen with an SBA 504 loan. So those are the two primary differences between the products. Both of the loans, the downside, I suppose, of getting SBA financing is they both have personal guarantees, borrower recourse. That's kind of a fact of life these days anyway, even from banks and credit unions on most types of loans. And both programs have prepayment penalties as well. And that also is a fact of life, unfortunately, for a lot of commercial loans these days, particularly in the 504 where you're getting so below market long-term fixed interest rates. So those are the primary differences between the two programs. I'm not a 7A hater, as some people would like to paint me out to be. That's not the case at all. But I am a huge champion of SBA 504 loans when they're used for the right purposes. And they do make sense. And by the way, you can use both loans on the same project. You can take out the intangible assets of the business and finance it with a 7A while you're taking the tangible assets, the equipment and the real estate, and finance that with a 504. I've done that many times as well. I hope this has been helpful. There's probably a lot more details I can go into that are beyond the scope of this video, but I hope this is helpful to you. If you have a situation that you'd like us to finance, please let us know right away. Thanks so much.